Pause for a second and actually let this land, because the next financial break doesn't hit America all at once. It hits zip codes first. It shows up as a county raising assessments, a state quietly adjusting what a pension promise really means, a city's budget suddenly depending on fees and fines, and a local bank tightening credit in ways you feel before CNBC ever says the word crisis. And here's the uncomfortable question that decides who gets caught early. Is your state already running the kind of math that only works if nothing goes wrong? Because we're not talking about vibes. We're talking about solvency. The moment where revenue gaps don't get patched with efficiency, they get patched with cuts, hikes, and delays. And in a minute, I'm going to walk you through 7 states that, based on the numbers underneath them, are positioned to feel that pressure first. More importantly, I'll show you what you should be doing right now if you live in one of them, because once this becomes obvious, you won't get the same set of options. The mainstream take is usually, this is like 2008, so just watch housing and the stock market. That's true, but it's incomplete. This isn't 2008. It's 2008 sitting on top of a system that never deleveraged. Commercial real estate is facing a maturity wall. About $1.8 trillion in CRE loans are set to mature before the end of 2026. At the exact moment, refinancing is harder and more expensive. National Association of Realtors, or. At the same time, office vacancies are still historically elevated, with markets like Manhattan running in the 20s on vacancy, depending on the segment. And state pension math is still fragile nationally. Unfunded liabilities are measured in the trillions, even after improvements, which means states are trying to fund yesterday's promises with tomorrow's returns. Now, here's the part people miss. That pressure doesn't begin at the federal level. It begins at the state level, because that's where the obligations are sticky and the revenue is cyclical. When a downturn hits, income tax drops, sales tax drops, property tax collections wobble, and suddenly the only way to keep promises is to squeeze the people who can't leave. So, if you want the real list of where this breaks first and how to protect yourself before the crowd catches on, subscribe. Because the moment your state starts talking about reforms and temporary measures, you're already late. Number 7 is Kentucky. Kentucky is one of the states Equitable classifies in the distressed tier, meaning funded status is below 60%. The kind of level where the plan can keep operating, but the system gets fragile fast under stress. And the trap here is simple. When a state has large, legally sticky retirement obligations and not enough flexibility in the budget, recessions don't create belt tightening. They create structural decisions. If revenues drop in a normal recession-style pullback, the state doesn't get to politely pause obligations. It either pushes costs onto taxpayers, trims services, or starts negotiating what people assumed was guaranteed. If you're a Kentucky public employee or retiree, the practical move is to stop thinking of your pension as a fixed asset and start thinking of it as a variable cash flow. Build redundancy. If you're a homeowner, your risk isn't just price movement, it's the combination of service decline and tax pressure. If you're renting, lock stability while you can, because landlords pass tax increases downstream. Number 6 is New Jersey. New Jersey isn't just high tax, it's high tax with limited remaining headroom. It's also at the bottom of the funded status range in Equitable's state-by-state funded ratio snapshot, sitting around 50% funded alongside Illinois. That's the kind of number that forces a state to keep raising contributions year after year, just to stay in place. And New Jersey homeowners already feel how the state solves problems: property taxes. In fact, New Jersey's average property tax bill crossed $10,000 in 2024. NJ Spotlight News. The risk setup is nasty. When obligations rise and the tax base shrinks because people and businesses relocate, the burden concentrates on whoever stays. So the moves here are defensive and boring. If you own a home, Run your all-in carrying cost with higher taxes as a baseline, not a worst case. If you're planning to sell in the next few years, earlier beats later when liquidity tightens. If you're a public worker or retiree, assume benefits can be restructured in ways that are politically framed as fairness. And if you keep significant cash in state, diversify banking exposure. Not because a New Jersey bank is automatically unsafe, but because localized stress shows up first in localized liquidity. Number 5 is Connecticut. Connecticut is the classic narrow tax base problem. When a disproportionate share of revenue comes from a small number of high earners, the state becomes sensitive to migration and market cycles. When even a small fraction of those earners relocate, revenue drops faster than obligations do, and lawmakers reach for the easiest lever: higher taxes on whoever remains, plus higher property tax pressure at the local level. And what makes Connecticut more dangerous than it looks is that stagnating or soft housing markets don't protect you, because even if your home price doesn't move up, your carrying cost can. So the practical strategy is to treat your location like a portfolio position. If you're high income, residency planning becomes a real lever, but it must be legitimate and documented because states audit aggressively. If you're middle income, your leverage is mobility and timing. Avoid getting trapped in an illiquid house while the tax burden creeps. Number 4 is Hawaii. Hawaii's issues. Hawaii's. Isn't that it's poorly managed in a cartoon way? It's that the economic structure is fragile. Tourism is discretionary demand, one of the first things households cut in a recession and one of the last to recover fully. When tourism slows, revenue slows, employment slows, and the cost of living squeeze becomes brutal because so many essentials are imported. In other words, downturns hit Hawaii like a double shock. Income falls while baseline expenses stay high. If you work in tourism or hospitality, you need a mainland option that's not theoretical. Savings plus a relocation plan. If you own property, understand the buyer pool is cyclical. Vacation and second home demand can vanish quickly when risk appetite collapses. Don't wait to see how it goes if your personal balance sheet can't absorb a multi-year slump. Number 3 is Illinois. Illinois is what happens when pension protections are strong, population growth is weak, and political flexibility is limited. Equitable flags Illinois at the bottom of the funded range, around 50% funded, which means the system survives by contribution pressure. More budget share diverted to yesterday. Add municipal strain on top, especially in and around Chicago, and you get layered stress. State obligations plus local obligations pulling in the same direction. When you combine that with commercial real estate weakness, downtown vacancy, and valuation declines, property tax bases get threatened at the same time service needs rise. The move here depends on who you are. If you're a homeowner, you're exposed to the tax up value flat scenario that silently erodes wealth. If you're a business owner, tax stability matters more than tax rate. Neighboring states can offer both. If you're young and mobile, mobility is an asset. The people who get hurt most in Illinois-style cycles are the people who can't move but are still leveraged. Number 2 is California. California gets framed as too big to fail, and that framing is exactly how people get sloppy. Yes, the economy is massive, but the risk isn't only bonded debt, it's revenue volatility and long-dated obligations. California's tax system is unusually sensitive to capital gains and high-income earnings, meaning downturns can punch a hole in revenue quickly. And the pension side is still a massive long-term claim on future budgets. Equitable's work shows that pension funding nationally is improving in some years and deteriorating in others depending on markets and contributions, which is exactly the point. A state that relies on consistent market performance to keep promises is exposed when markets don't cooperate. Add the commercial real estate stress in certain urban cores. San Francisco office availability has been reported in the mid to high 30% range in recent periods, depending on the metric. Avison Young Dot Wunsch 3. If you're high income, the real risk is policy reaction. When budgets tighten, lawmakers start looking at fair share language, and that's when new taxes, enforcement, and restrictions show up. If you own property in expensive coastal markets, watch liquidity more than comps, because liquidity is what disappears first. And if you're building wealth, you need a plan that works if state costs rise while asset prices stall. Number 1 is New York. New York's exposure isn't only the state. It's the fact that so much of the revenue engine is concentrated in New York City, and New York City is unusually sensitive to two things happening at once: commercial real estate stress and high-income job disruption. Manhattan vacancy has been running in the low to mid 20% range in major market reports. And when office valuations reset, that's not just landlords losing money. That's the tax base getting repriced. At the same time, finance and professional services are exactly the types of sectors that will use automation aggressively, and New York's revenue depends on those high-earning roles. So the feedback loop looks like this. Revenue falls, budgets tighten, services get strained, taxes push higher, and higher earners accelerate relocation, which shrinks the base again. And then you add transit. The MTA's long-term funding pressures don't go away just because ridership improves. The system is carrying legacy costs that don't shrink at the speed demand can shrink. Now, across all 7 states, the pattern is the same, even if the details differ. When long-dated obligations collide with cyclical revenue, the solutions are always some combination of higher taxes, weaker services, and renegotiated promises. People hear that and think it's political. It's not. It's arithmetic. So here's what you do if you're in one of these states, and I want you to treat this like a checklist, not a philosophy. First, stop planning off normalcy. Stress test your monthly life with higher property taxes, higher insurance, and at least a temporary income disruption. Second, don't keep all your financial relationships local. It's fine to bank locally, but diversify institutions and account types, so one localized freeze doesn't trap you. Third, if you're relying on a public pension, build supplemental income and liquid reserves as if the payout could be reduced or delayed, because the people who get hurt are the ones who discover they have no buffer when reform arrives. Fourth, treat mobility like insurance. Even if you never move, knowing you can move changes how you negotiate jobs, housing, and risk. Before I wrap this, quick note. If you want the framework I use to stress test situations like this without spiraling into doom scrolling, I put it into a free guide that breaks the signals down into a simple decision structure. It's the first link in the description. It's not financial advice. It's a way to see the risk clearly so you can act early instead of reacting late. And one last thing. The point of this video isn't to scare you into thinking your state will collapse tomorrow. The point is that fiscal stress is a gradient. It starts quietly, it becomes normal, and then one recession turns it into a hard problem. If you live in Kentucky, New Jersey, Connecticut, Hawaii, Illinois, California, or New York, tell me in the comments what you're seeing locally. Tax notices, service cuts, pension headlines, local bank tightening, because the national narrative always shows up after the local reality. Next video, I'm going to break down the 3 specific triggers that turn budget stress into financial restructuring, and how to position your household before those triggers fire. It'll be linked in the description. Take care. https://www.nar.realtor/magazine/real-estate-news/commercial/don't-panic- as dash trillions, dash in, dash commercial, dash loans, dash come, dash do, question mark u, tm, underscore source equals chat gpt.com. Don't panic. As trillions in commercial loans. Come do to https://www.nj/spotlight-news.org/202-5/03/average-200-first-time/question mark UTM underscore source equals chat gpt.com. The average NJ property tax bill in 2024 was record high $10,095. Saj NJ https://www.avison-san-francisco/san-francisco-office-report-q4-2024-1 question mark UTM underscore source equals chat gpt.com San Francisco office market report.